In risk management, credit losses are usually modeled so that they are accounted by two different, though linked, factors: expected loss and the unexpected loss. In this video, we're going to focus on the first, the expected loss. The one of expected loss is a fundamental concept in banking and finance, especially if you consider that International Accounting Principles, IFRS, do take it into account, as well as banking regulation also considers it an important pillar in assessing capital adequacy. The expected loss is the percentage loss that a financial institution forecasts on average over a certain period of time, which is usually 1 year. At the most fundamental level, expected loss can be described as the risk of default. If you assume that your risk is a probability of default, or PD, let's say of 10%, which is high, by the way, it means you expect to incur into insolvency 1 time out of 10. This would mean that you expect a 100% loss 10 times out of 100. The probability of default depends on the creditworthiness of the counterpart. This is somewhat unreasonable because what we see in reality is that usually losses do not accrue to a complete wipeout of a loan in case of default. When default occurs, thanks collateral for instance, a lender usually recovers some capital. On a more sophisticated level, expected losses are the product of two factors: probability of default and the loss in case of default, which we call loss given default, or LGD. That depends on the degree of collateralization. Let's say that you expect to lose 30% if default occurs. This means that when default occurs, and that happens 10% of the times in our example, then you expect to lose 30%. That is, your expected loss then is 30% times 10%, or 3%. And then at last comes the concept of exposure risk. If you predict exposure to decrease in time over the next 12 months, then the expected loss would be lower. If exposure can increase over time, then expected loss can be higher. Let's say that you expect exposure to be 20% lower than currently is when default occurs. That's the exposure risk. Then we call exposure at default, or EAD, 80%. In a term loan, exposure at default tends to be lower than the current exposure, while in a credit revolving facility, it can even be higher. By using the numbers we have chosen in this first example, we have an expected loss of 10% times 30% times 80%, which is 2.4%, namely PD times LGD times EAD, respectively. It's the past experience that teaches a financial institution how to gauge these numbers.